Stocks mixed as investors cautiously count down to President Trump's highly anticipated Liberation Day rollout of sweeping new reciprocal tariffs. For more on what's coming next and what it does mean for the markets, let's now welcome in Venu Krishna, Barclay's head of U.S. equity strategy. Venu, it's always great to see you here on set.
Thank you.
Let's start there. Let's start with Liberation Day. We've all been waiting for it. Or the expectation, Venu, is Trump's going to come out and announce this slate of reciprocal tariffs. Do you think, I'm just curious how you think about that as a strategist, do you think tomorrow will it mark the end, Venu, of all this tariff uncertainty? Is that it? We're going to hear it, the announcement, then we can all move on?
Absolutely not. But I would say that a subsection of investors I talked to do think that somehow April 2nd is a clearing event, and then life will settle. Our view is that that's just a starting point.
And why do you think that, Venu?
Because it takes a long time to reciprocate and to haggle and to settle on the ultimate terms. And if it especially starts going on a bilateral basis, then you're doing against each bloc or a country at a time, right? And so this time, it appears that they are going to focus most likely on countries with the biggest trade surpluses versus the US, and ones which also have meaningful amount of tariffs on their side, right? And so to some extent, they will try and negotiate to level the playing field. To ultimately, the goal is to have more US access to those markets, for example, right? And the secondary objective looks like also is they want to somehow see this as a source of revenue to ultimately reduce your deficits, even though I'm not too sure how they can manage, given the scale of a deficit, which is running 6.5% to 7% of GDP. So I think this is going to be real. It's not going to be settled right away. And it probably takes at least 3 to 6 months. And that's on the optimistic side. And that's my base case. But things can go wrong.
Now, you said this is a starting point. Your job is to provide us all with security of forecast. Like, how do you deal with this uncertainty when you're thinking about S&P 500 targets, when you're thinking about the stock market, when you're thinking about impact on earnings? Like, I want to know, and I just can't know.
It's a great question. It's a very complicated question. But we've spent a lot of time and effort on trying to create a framework for that. So I would explain that in a two-step process. First is, till now, what we were doing is estimating the direct impact on earnings from tariffs. And that in itself is complicated, and you have to make a few assumptions because no company reports its imports or exports. So we used macroeconomic data and somehow from there mapped it to the S&P and sectors, and then found a decent framework with the core assumption to estimate that impact. That's only one part of it. But remember, earlier, before I cut my price target in earnings, we were not incorporating that into our base case. It was there in my bear case, but not in my base case. Because the view was they will figure out some way to negotiate this and not let it escalate. But clearly, we are not in that zone. But what is even more important, and we said that even then, but now we're explicitly capturing it, is the second order effect, what I mean by that is, for example, our economists think that given a core level of tariffs, inflation is going to go up and the economic growth is going to slow down. And this is, even before this has happened, we were expecting growth to moderate because of immigration changes. So without even Trump going towards more hardline immigration strategies, in the Biden administration, middle of last year, you already had that stay in Mexico in case. So we were having almost 2.5 million immigrants net coming to the US. That was expected to go down to less than 500,000. So that supply shock in itself was likely to bring down and moderate growth. But now with the tariff rhetoric also escalating, we are forced to consider that. So now to answer your question, we look at the first order direct earnings impact, and then we also estimate the second order impact, which means that we now assume that consumption reduces, especially on goods. We assume that US economic growth moderates, especially industrial production. We assume non-US growth declines, and we assume that inflation also picks up. Once you start putting in all these factors to give you a sense of scale, earlier, before I cut my numbers, we were expecting S&P earnings to increase 12.5%, an acceleration from last year's roughly 9-10%, which was very, very healthy. Now, we expect earnings growth to go 6% in my base case. which is not the extreme case of tariffs. It assumes that the 20% extra on China sticks, and the reciprocal tariffs, because we don't know the level of details right now, we assume that there's an across-the-board trade-weighted increase of 5% for the rest of the world, right? Which is reasonably conservative, but it can be worse than that, not better than that, most likely, right? Under that scenario, my earnings forecast is essentially cut by almost 50%. I have a bear case in which S&P goes to 4,400. In that case, I have earnings going down about 2.5%, right? Which means a swing of almost 15 percentage points from where we were earlier. So the magnitude of these changes is big. The second is, what multiples are you willing to pay on the market, right? And so, we take a sum of the parts approach for S&P, in good part recognizing the structural change in US equity markets over the last 15 years, which is essentially the primacy of the tech sector, which today in aggregate accounts for almost 40+% of S&P. And within that, big tech as a group of just 6 stocks, you don't include Tesla in it, itself accounts for 30% weight, 25% of S&P earnings, and more than 50% of S&P returns in the last 2 years, right? So to give you a sense, that particular group of stock, which is very critical and has been the fulcrum of this market, their multiple was 31 times at the beginning of the year. Last summer, it was 34 times. So we already derated. Now we're sitting at closer to 24 times. That's a 21% derating in big tech stocks, which is driving the market. And that's why, interestingly, as much as everybody talks about the sort of sell-off which has happened, one, it has been very orderly. The realized S&P volatility as the market is sold off is extremely low. So there is no panic out there. So the sell-off was also broadly has been more concentrated in tech, especially big tech, with a 21% derating, which is basically telling you that the market is highly uncertain about the growth prospects of the US economy. On top of that, big tech has its own issues where in the last 6 months, there's been an intense scrutiny on the intensity of capital spending and trying to find out when will they start monetizing it to be able to justify those hundreds of billions of dollars of capex. And that's why, I think we were talking earlier before the show, we are still positive on big tech. We've been positive since the fourth quarter.
And so is that Venu, it's a valuation call on big tech, and obviously you must project solid earnings growth?
Yeah. So the consensus earnings growth for big tech is around 16% for this year, which is extremely strong compared to the rest of S&P. We think actually the number will be closer to 21%. If you look at the last 6 quarters, they've been beating their earnings number by anywhere from, call it 8.5 to 14 percentage points, right? So we do expect that to moderate, but they moderate it to still very healthy levels. But what we do recognize is in this environment of macro uncertainty, an environment in which there's more scrutiny on the capital spending and their ability to monetize it, and also where on an idiosyncratic basis, for those individual big names, there are concerns cropping up. For example, when you look at Amazon, people are saying, what is the scale of competition AWS faces from Anthropic? Or as hyperscalers as a group, are they properly depreciating their server useful life at a time when chip technology is changing so fast, right? So there are some questions cropping up. So all that tells me is that these companies will have to deliver and the macro uncertainty has to moderate and they'll start working. But as the derating goes on, they actually become safe havens because if things really start going wrong, remember this is one subgroup of stocks where the quality of earnings is extremely high, right? And even now as a group, their free cash flow yield is close to 3.5%, right? And the multiples have come down 21%. So where do you want to hide if things go wrong in that bear case scenario of let's say S&P earnings going down even further? I mean, we cut our numbers for S&P from 271 earlier to 262. Consensus is still closer to 271. I think they're going to come down.
Venu, it's always great to see you, especially here on set. Thanks for joining us.
Thank you.